Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Michael Oliver of Momentum Structural Analysis. How you doing today, Michael?
Very good, Darrell. Good to be here.
So, Michael, you recently put out this report, and this is the gold versus the S&P 500, and we see that gold continues to bump up against this spread line, and it looks like it's poised for a breakout. And so I want to get your perspective here. I mean, you actually have the comment on this particular chart to nail this to your trading wall room. And so you were pounding the table on this. And so I would love to get your perspective on the gold and what are you expecting to happen next?
If I had to say there's one chart that's more important than any other chart, including S&P, NASDAQ, gold, silver, any of them, it's this one. What it shows is gold, ounce of gold, using front month COMEX contract, divided into the S&P price, okay? And you can see back in 2011 through 13, especially in 13, which is where this chart starts, gold was collapsing in price also against the S&P. It was losing value to the S&P. And when gold bottomed in late 2015, that spread reached down to about 50%, that first little circle you see there. And at that point, you can go sideways for 10, 11 years now. And it's been above that level and below that level, but basically par to the S&P. In other words, it's, depending on the point in time you pick, it's doing better or a little bit worse than the S&P, but basically going sideways, okay? Meaning it's not really been as bad as people think. And it's not just recently that gold's firmed. It's at the upper end of the 11-year range right now. But this thing has built a technical base that is so clear it smacks you in the face. It's hit 1, 2, 3, 4 times as of April this year. You bumped that line, backed off again. You're back pressing at it right now. In fact, you're above it intra-month. This is monthly closes. So gold into the S&P. And you close the month where you are now. Divide gold into S&P. It's going to break out. What does that mean? It means that this is a fresh, massive technical base breakout. Treat it as a price chart. If you looked at this and saw it as a price chart, you say, oh boy, I'm going to get on board. And I'm going to buy. Well, this means buy gold, sell S&P. In fact, you want to go market neutral, buy gold, sell S&P. You put a spread on. But it's also telling you that gold is going to surge versus the S&P. Now, by the way, when we do this same chart, we didn't have it in this report, versus the Dow, or gold versus the New York Composite, both very broader indexes that aren't front-end loaded with a couple of AI stocks like the S&P is. Gold's already broken out. But when this guy breaks out, this spread breaks out, it's telling you as a major asset class shift is underway, it's commencing. Gold is now going to outperform the S&P. So if you invest over spans of time and want the better asset class, it's saying gold is going to lead the S&P now. It's the better place to be. And our assessment is, one, it's going to be the consequence of two things: gold going up and S&P going down. Okay. So this is our table pounding technical chart to nail you all. If you're in the stock market or the gold market or wherever you are, this is the most important breakout that's about to occur. And if it breaks out, which it will, this is too persistent, okay? It's saying, I just began. So if you think gold is old, it's just begun its major shift against the paper bubble, the U.S. stock market. Just began. It ain't going to end in 3 months. This is something going on for years. So don't think of gold as being at the end of something. It's just beginning when you measure it versus the U.S. stock market. And again, it's already broken out versus the Dow or the New York Composite. It's about to break out versus the S&P. So this is a very important investment grade technical chart.
Yeah, this chart is very interesting because we had the Morgan Stanley chief investment officer pretty much advised that folks allocate 20% of their portfolio to gold, which is significantly higher than where it was before. He still mentioned 60% to stocks. And so just thinking about that, I'm wondering, obviously we had a period of time where, the Fed printed money. Many people ran into the equities, ran into the S&P 500. S&P 500 still highly elevated. And so you mentioned that this is like the beginning and this could last for years. Do you see like is this like a structural shift, or is this like a temporary, for the commodity cycle?
I think this time around in the major markets of the world, gold being one of them, the monetary metal been around 3,000 years, silver as well, that the ongoing process we've had for about 100 years now, one long human lifetime only, of the Fed, one, have a monopoly control over the quantity of money and a monopoly control over the pricing of money. Okay. Now, if you had that over, let's say, the price of corn, and the government said, okay, corn's essential, we're going to take control of that market. We're going to determine the quantity that's produced every year and the price we're going to sell it at. Well, people would say, well, that's socializing the ag industry. It's what Mao Zedong did. They gave that up in the 1980s in China, by the way. They privatized. But nobody comments on that. It's an inefficient way for the most essential commodity between human beings when they make a transaction, whether they know each other or they're separate parts of the world, to be distorted by a central bank. Well, if that is not causing good effects, boom and bust cycle after boom bust cycle, and it's going on in Japan as well and in Europe and so forth, there's a point at which people finally say, hey, I had enough of this. It isn't working, especially if you inflict pain on them. And I think if you take that stock market down, and we think it's in a topping process, it has been since early this year. New highs don't change that. Our momentum work says momentum is peaked, price is waiting, it usually lagged the momentum. But if that guy goes down, and you start to get the wave effects in the real world, like we did 2007 to 9, if you'll recall, people that weren't even in the stock market were hurt badly. You inflict pain, people are already hurting. We know that. Consumer credit's maxed out. The number of card delinquencies is exploding. Failure to file tax returns, et cetera, et cetera. You take that market down and real world consequences get worse, you're going to have people throwing their arms up in the air saying, gee, neither party seems to work. What do I do? And that's when academicians come in, and they have influence because they often are brought into the government as well. They'll say, hey, this central bank thing, this hasn't really been working like we thought it would. Instead, it creates boom busts. So you could end up with a situation this time around where gold goes up and becomes monetized. Silver with it. Where suddenly you go to a new price level, not just because of industrial demand for silver or anything like that, or repricing it out of an old reality into a new reality. We can get onto that in a minute. Where bigger decisions are made such that when gold goes up next time, all of a sudden this country, that country, that country, that country. No more fiat currencies backed by real stuff. And that could be the outcome of this move. So this stock market move, this gold move, commodity move, all the things we can talk about here shortly, could be different this time. They're likely to be in terms of significance.
Yeah. So the gold to S&P ratio was a lot higher and coming out of 2013, and you have that chart that goes back to that time period. Where could gold be headed from here? I mean, obviously it's moved significantly since the beginning of the year and last year as well. And so just curious on your thoughts of where gold could be headed.
I'll give you two examples. You only have 50-year history. The U.S. government legalized it, in January 75, Over that time, there have been two major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were eightfold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, eightfold, bear low to bull high, We're only fourfold. We started from a bear low at 1,050. Multiply times 4, You're a little bit better than half the dimension of those two prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade. Okay. So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. So I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. They're not evident right now to most people. All they're focused on is AI, you know. But if all of a sudden other factors come into play, especially negative ones, hands go in the air, emotions occur, politics becomes dissembled, which it's already become. I mean, the two parties are fragmented internally, getting worse even on the GOP side's fragmenting. Suddenly, people don't have a sense of, well, you know, it's 52 card pickup. And there's one thing they can rely on, like their granddad told them. Keep those gold coins, those silver coins. Okay?
Yeah.
You know, and all of a sudden, those monetary metals are again monetary metals.
Yeah, there's been a lot of talk about gold revaluation by the United States government. You know, and some folks are saying like, hey, I don't want to wake up one day and gold be revalued at, I mean, right now it's valued at $42 on the books. And I'm kind of wondering like, how would that interact with the momentum here?
All kinds of factors like that. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there. Okay. They don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that too. And capped it off for the last 50 years. Well, copper and lead have quadrupled. You know, I'll get into that in a second. And suddenly I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold.
Silver versus gold.
Yeah. Okay. Now,
what's happening here?
This only goes back to 2020. Okay. So 5 years. We know in early 2020 into late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the assessment that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. And some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more, the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners.
Yeah, I want to look at the silver ETF versus GDX.
I got that. This sort of reflects what you saw in the silver gold chart. Back in 2020, you had this surge where the silver miners beat the gold miners. It's like buying a stock at about $96 and it goes to 135 in 6 months. The spread went from about 96% to about 135. Divide the price of SIL, the miners ETF, into the price of GDX, which, by the way, does hold some silver miners, but it's primarily gold miners. But since then, even though SIL and GDX are now above, have advanced, and they're above that 2020 price high, the spread is not, meaning the silver miners have sort of gone sideways on the spread chart back to 2022. I've got a little black line there on the top chart, horizontal line that shows that they've oscillated either side of sideways since 2022. So for 3 years, basically the silver miners haven't really underperformed, but they haven't outperformed. But there's a structure, that green line, that's been hit 4 times since 2022. So it's a clear structure. You close a month out above that green line, and right now we're pushing to do it, the current levels reading of SIL versus GDX, then not only is silver breaking out versus gold, but the silver miners are saying, I'm breaking out versus the gold miners, which would echo what we're arguing is likely to be the case, silver versus gold. So my emphasis among the miners now is to buy silver miners as opposed to gold miners. I think they've got a lot more to go on the upside.
Okay. Yeah, I appreciate that.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I want to get your perspective on when we look at momentum, and obviously different factors drive momentum. And right now, the silver mining output has been in the deficit for the past number of years. We've had silver come out as was put on a critical minerals list by the United States government. And so what's your perspective on like these fundamental factors and how that interacts with the momentum?
Well, as you know, and I know, silver's had a supply-demand deficit for 5 years, and yet everybody ignores it, okay? And we know that silver is no longer used in photography. It's used in solar panel production, which comes from China primarily, about 80, 90%. And it's in high demand globally, and it's growing annually, especially in countries like Africa that, don't have major power systems, and therefore solar power is very important. So there's a great rising demand worldwide for solar panels. It's also used in high tech, in AI and so forth, in microscopic forms, yet it's pervasive. It's an essential conductor. So demand for silver as an industrial metal has been already in a supply-demand deficit, yet silver hasn't responded. It's still stuck in that range of 50 years ago. Well, it's slightly out of it right now, but how come silver's been in that range? And let me comment on that for a second. We went back and studied, and we could have thrown darts at many commodities, but I threw them at copper and lead. Okay, and I went back to the late 70s, 80s, 2000 to the present. And in fact, I got the charts from the Federal Reserve of St. Louis. They have a base metal price charts. And there was a range, a reality for copper price and for lead price from the 70s, 80s, 90s into mid 2005, 2006, and 7, where they were stuck in this multi-decade range. Just like silver's been in this 50 to under $10 range, back and forth, but for 50 years. Copper in 2005 and 2006 broke up out of that price range and literally in a couple quarters quadrupled in price. Oh yeah, it had a hard sell-off after that, but it never went back to the old reality. Instead, the average price for the recent decades has been what? 4 times the price of the prior decade. Look at lead, same story, different year, happened in 2007, broke out of its little quiet reality, quadrupled in price, actually more, in a matter of a couple quarters, and lived in a new reality. How come silver's still stuck, or has been stuck, for 50 years? Gold hasn't done that. Gold's continually made dramatically higher highs at each move, but silver's been capped. Well, one argument is, and it's got backing, is that banks, probably backed by the Fed or encouraged, have been trying to control silver price. Ultimately, that kind of manipulation doesn't work. Reality takes over. And sometimes when you compress something like that, all you've done is make it explode even more when it unleashes. So good luck, guys. I think we're on the cusp of that right now. And I think silver is about to do something. And we see it in the technicals. I see it in the spread relationship. That's why I'm watching gold S&P, moving in the monetary metals. So this industrial aspect you mentioned, yes, it's a factor. But ultimately, there's bigger factors. And it's the movement in asset classes into monetary metals because of the perceived, and I think will show itself very soon, actual vulnerability of the stock market, especially the U.S. stock market.
Yeah. Okay. So some folks would, argue that, okay, we're going to get a sell-off. People are going to need liquidity, and they have these price targets set at, 3,200 on gold, or they may get back into silver at, $34, $35, whatever the case may be. Right.
Yeah.
And I'm kind of wondering, if those price levels, we've already surpassed them. Like, are we going back?
No.
Could we go back to those price levels or what?
We're on the cusp of a major reality, a new reality for silver. And I'm arguing it's highly likely to happen. First off, if that spread chart I showed of silver versus gold with that ceiling goes back over 3 years, boom, boom, boom. When you break out over that, same spread chart event occurred 5 months before silver reached $50 in 1980. It moved from the 20s, from the 15 level, I think it was. It's like a quadrupling in price of silver in 5 months. And the only technical we can find that said it's about to begin was not the bull trend in silver. It had already been going on. It had been going up for years. Suddenly it went electric. That spread broke out. 2010 and 11, silver had already been going up since 2000, 2001. And in 2010, in September, through April 2011, silver went up in that 7-month period, double and a half. Bam, the spread broke out first. That spread breaks out, we set the clock. And I'm arguing that probably in the next couple of quarters, remember the copper move and the lead move, and there's plenty of other markets that have done that, I expect silver maybe be $200. That fast. And people are looking for normality. Like, we go up 4 steps and pull back 2. Go up 3, pull back 1. All that nonsense. The norms will be shattered. And you'll go into a new reality. And yeah, you'll get a sell-off at some point, but it's likely to be in a reality it possibly even overshoots what a real price conversion of silver would be, factoring in the decay in the value of the money unit, the dollar. Not versus other currencies, but its real value, the quantity of dollars, the M2 chart, which is, goes up about 90% in supply every decade. Okay. And so being $200 might just remotely match the 1980 high. So, and I expect it to happen very quickly. And frankly, if you're not there, you're going to miss it. But don't use the normal tools. They won't work.
Yeah. Okay, so I recently watched the episode on commodity culture with Jesse Day, who's another host here at VRIC Media. And you mentioned that commodities are dirt cheap. And so obviously many folks are talking about oil being cheap, silver obviously cheap. And so just wondering if you have any other commodities in mind that are cheap, or just get your overall perspective there.
First off, Bloomberg Commodity Index is what we look at. Some people look at other end. We like that one because it's well balanced. It's not so heavily overweighted in energy, for example. It's got metals, base metals, meats, grains, etc., sugar, things like that. It does not correlate to gold over time. Sometimes it does, sometimes it doesn't. In the late 1970s, it coattailed gold up to the 1980 peak. But it began a whole year after gold had already turned up from a 1976 low. Commodities didn't turn up till 77. And they didn't match the dimension of the gold move, but they followed it. But if you'll look, for example, from 2015, commodities were at a low. Gold was making its bare low then, late 2015. Gold doubled between 2015 and 2020. In fact, it went from 1,050 to over 2,000, okay? During that same time, the Bloomberg Commodity Index ratcheted lower. Didn't collapse, just kept going down. So it didn't correlate to gold. Oil correlates well to the Bloomberg. All the basic commodities you can think of correlate well. Silver does not correlate well to the Bloomberg and commodities. Commodities can have a downward trend and silver go up with gold. Silver correlates to gold. It may lag or lead, but it will be in the same direction. So to make a mistake of thinking if commodities go down, that could hurt silver. No, the correlation doesn't exist. There's very few times where you can find that linkage. But right now it looks like the Bloomberg, which is a very cheap category. It's for the last 2 years after the correction that occurred from the 2022 high when that war started, commodities peaked, okay? They didn't go up because of the war, they peaked then. They dropped back to 100. Well, heck, the high in the Bloomberg Commodity Index in 2008 was 238. Right now, we're trading at about 110. We've recently broken out. The October close for us, which was above a key level for us, which is in the 106s, said the Bloomberg is waking up. It's going to go up again. Right now, oil is a laggard, a weak component within the Bloomberg. Copper strong. Grains are starting to assert themselves via our momentum metrics. Meats are strong. Base metals are strong. Oil will follow the Bloomberg. Right now, it's probably in a slingshot position where you're right, it's cheap. In fact, I understand that most companies that produce it really aren't hedging here. They think it'd be foolish to hedge the oil production here at these price levels. We've got some trigger numbers on crude in the 63, 64 range, and a big trigger number at 68. Well, right now we're under 60. But it won't take a lot to get up to 63, 64, and if you do, watch it, because oil could then quickly join the upturn that's already underway in the Bloomberg. But when you go back and look at history, measure Bloomberg versus S&P, it's like, is it going to zero? No, of course not. It's gone sideways for the last couple of years versus the S&P. So we think it's collapsed since, for example, its high relationship to the S&P. It peaked in 2007 or 2008. Commodities did peak and went down, and they went down more than the S&P because the S&P was about the bottom in 2009. So the S&P went up and Bloomberg went down, but the relationship between the commodity category and the U.S. stock market has probably never been so cheap. And from an investment category perspective, we think that spread is basing, meaning it's not going to lose value to the S&P anymore. and likely about to turn up. So from a, let's call it a long-term investment point of view, it's time to start thinking about commodity-related stocks, which don't behave like the S&P. And it might be a great place to be for the next decade. Because we know one thing's going to happen. When that stock market breaks and the data points go dark, real dark, central bank's going to print like crazy. And they already announced, one of the Fed governor in New York said today, he didn't say the word print, but he says, we're going to start buying T-bonds, long-term debt market. Why? Because they're, quote, illiquid, meaning they ain't behaving the way the federal government wants them to behave. So they're going to artificially come in, create money, and buy T-bonds. Well, that's part, the river flow will increase again. This time, instead of going into the stock market, 2000, 2002, 2007, and 2009, they pumped money like crazy, but it wouldn't stop the stock market bubbles from breaking. The money went elsewhere. And right now, I'd argue that the stock market's topping, as we argue it is, that when it does, the money flow will increase, but it will go into other things. It's gold and silver primarily, but also cheap commodities. I think they're a great investment category. Reality, in other words. Invest in dirt. Yeah. Okay? You could probably buy cow manure if you could store it and make more money than being in the S&P.
Yeah, we're in a new reality for sure. I've mentioned this a few times with the audience, so sorry you all get tired of me mentioning this, but the Morgan Stanley chief investment officer recommended that folks allocate 20% of their portfolio to gold, which seems like a significant amount and an abrupt change, right? It changed so quickly from the 60-40 to 20% gold.
20 in bonds now, yeah. Anyway, that's a nice admission. That's an objective omission by the admission, by Morgan Stanley. I think some others have recognized it as well, and it'll become more recognized. But when the average American, which is investors in the Western world, have not committed to gold yet, we know that. Far less excitement about gold than still the stock market. Okay. They better be careful, because when that shift occurs, the stock market starts to break in a way that suddenly puts a frown on people's face. Because, right now, the only thing the average middle class guy's got to smile about is his retirement account, which hopefully reflects the S&P. So he's up 10, 15% on the year, while gold's a lot more than that, silver too. But you take that away from him in the last month or two of the year, and suddenly, he's not really smiling anymore, because he's got nothing else to smile about. He's maxed out his credit cards. He's late on his mortgage payments. Oh, his wife just got laid off. Oh, et cetera. That's when emotion occurs. And that's when market dynamics suddenly get more violent. And certain assumptions that have prevailed for decades go out the window. Like, hey, do we really need a central bank? They haven't been doing very good. I can't pay my taxes. If all of a sudden enough Americans, simply because they can't pay, don't pay, then the federal government have to reassess the viability of the IRS as an income source. And if it's perceived by the government as being not really viable in terms of getting what it's supposed to get, they'll have to go to a national sales tax. So I wouldn't even be shocked that, we don't have income tax at some point in the future once the crisis hits, because people simply can't pay. And even when you're driving down the road and you get your Sirius radio on and you listen to CNBC or CNN or Fox Business, you hear constant ads about, we can help you with the IRS. We can help you with the IRS. We can help you with consumer credit. I thought everything's supposed to be good. And yet 2/3 of the ads are sort of saying something. You get my point?
Yeah.
So emotion,
for sure.
Emotion is the thing that is a tipping point issue right now, and I think it's about to come into play.
Yeah, I'm imagining a world with no income tax. That would be very detrimental for tax receipts, and I think that there would be a huge amount of money printing to cover that
Yeah,
gap.
no, they'll go to a sales tax too, and then make your local shopkeeper become a tax collector. But that
Yeah.
was already even under Trump and his first administration. One of his economic, I think Steve Moore, suggested sales tax then. And Trump's already said, if we do the tariffs, we may not need income taxes. Well, you give him an excuse, like it's not viable. Not a tax revolt, just people, hey, you can't pay. So all of a sudden, 25% of your taxpayers asking for delays or programs or whatever. So it's not functional anymore. Then suddenly he'll say, I'll make them feel good. I'm going to abolish income tax. He knows that'll make people feel good for a while. Of course, you could hit him with a sales tax or something like that, or higher product prices because of the tariffs, et cetera. But anyway, a lot of big variables out there that will suddenly come into gear and change all the dynamics that we're thinking about.
Yeah, for sure. Well, appreciate that insight and that perspective. So, Michael, where can people connect with you? Where can they access this report? You're putting out these reports pretty frequently, and I think it's great for the audience to be able to have access to that.
Our all asset category subscription, we cover the bond markets, foreign exchange, stock markets, commodities, including gold and silver. Emphasis on that category. It's important to know, what these other things are doing, because don't just look at gold, like that. Look out your side mirrors at the other asset categories, because they will ultimately have an impact one way or the other, positive, negative, and et cetera. So you got to look at all four categories. Oliver MSA is our site, Oliver MSA for Momentum Structural Analysis. We put out a major weekend report, usually a dozen or more pages covering most of those categories, and usually about 4 reports during the week. So about five or so reports a week covering things we see going on in those categories. And we have a different perspective. Price charts to us are secondary. We look at momentum structure, because when momentum structure develops a clear structure like a price chart does, like a base or a topping pattern, momentum usually break out first. So it warns you before price ever taps you on the shoulder. So anyway, Oliver MSA.
Okay. Well, you all be sure to go check that out. Also encourage you to click the subscribe button. Love to have your support. Also click the link that is pinned in the comments to the VRIC conference coming up in 2026. Love to see you there. And until next time, Michael, thank you for coming on the show.
Thank you, Darrell.